Corporate Finance Presentation Dividend Policy Overview. Get ready, it's time to take our chance with corporate finance. Dividend policy, the policy as to whether or not a company is going to be distributing dividends to the owners being the shareholders or stockholders, and if so, how much will the dividends be that will be distributed? How much will they be going up over time? There are many factors that will come into play, including how big is the company? Is it a publicly traded company? Where are they on their business cycle? What do the shareholders of a particular company want? What kind of industry are they in? So it could be a complex issue, but let's first break it down to the options with regards to the retained earnings. So the retained earnings of the company basically has two options for that earnings. They can either hold on to the earnings within the company, or they can distribute the earnings out in the form of dividends to the owners, that being the shareholders. So they can retain the earnings, which is to keep the earnings in the company and use for future growth. The reason a company holds on to the earnings is for growth. Remember that a company does not have the objective of just accumulating cash and holding on to, say, assets or money per se, just to hold on to assets or money. Their goal is to generate revenue. If they're holding on to the earnings, that should be because they're going to be investing that into things like property and equipment, getting a return on it, increasing the value of the company, which should be beneficial to the shareholders. Now, if they're not doing that, if they are not getting a sufficient return for various different reasons, there could be valid reasons or various reasons why that would be the case, then you would think they would want to take that money and give it to the owners in the form of dividends. So then the owners can take that money, so they would pay the earnings to the stockholders as dividends, and the owners can take that money and do whatever they want to with it, investing it possibly in some other investment where they can be getting a return on it. So these are the two primary objectives that a company can do with regards to the earnings that they're generating. When you're thinking about the earnings, you're thinking about the accumulation of earnings from the operations of the company running through the income statement in the form of ending at net income, then rolling into the balance sheet from an accounting standpoint in the form of retained earnings. Retained earnings is the earnings that have accumulated from the operations of the company that have not yet been distributed. Let's just take a quick look at a balance sheet here just to get a better idea of that. Notice if we see our balance sheet, we've got the assets, liabilities, and the equity section. We're mainly focusing here on the equity section as we focus in on the distribution of the earnings. So the assets represent what the company has. Why does the company have those assets? They have the assets because they want to get a return on those assets. They're not here just to simply hold on to assets and accumulate assets up forever just so they have a mountain of assets. Because if they're not getting income generating revenue on them, they should be distributing back to the owners in the form of dividends so that the owners can then get a return on them. The reason they have the assets, in other words, is in order generally to generate revenue. Then we have, of course, the liabilities. Those are the debtors' claims to the assets of the company. And then we have the equity section over here, the equity section representing the owner's claim to the company. This, of course, is where we're focused in on here. Now, if we pull out the trustee calculator, we can see this is in balance because the assets equal the liabilities plus the equity. And we can also rework the accounting equation of the assets 1335000 minus the liabilities 348000 is going to give us the equity of the 987,000. So the 987,000 basically is the book value of the company, or in other words, the owner's claims to the assets. Now, note that if you're talking about a sole proprietorship, a partnership, or a corporation, the total equity kind of represents, in essence, the same thing. It's the owner's claim to the assets of the company as opposed to the debtor's claim, the liability claim to the assets of the company. The difference between, so if it was a sole proprietorship, the whole thing would be owned by one person. If it's a partnership, then it's owned by multiple partners. And if it's a corporation, it is, of course, owned by the shareholders. Now, note it's where the detail up top comes into play that looks a lot different from the types of entities. If it were a partnership, we would have to break out the owner's interests by partner, in essence, and have different capital accounts for each. For a corporation, the great thing about a corporation is that we can basically have those fixed units, kind of like dollars, almost like currency of the ownership of the corporation, and that fixedness gives us benefits, but it also limits us in flexibility to some degree. And remember, with a partnership, you can have a lot of different things going on. The partner can basically put money into the company, take money out, and not do the same thing as the other partner and whatnot. You can have different agreements that would be involved. With a corporation, we have to standardize the shares because that's the point of standardizing the shares. And so when you look into the equity section, then that's how we basically break it out, right? We break it out by how much the owners put into the corporation from the issuance of the stock versus the earnings that had been retained from the corporation that have not yet been distributed out. So let's just kind of review that really quick. If we have the shares here, the shares for the 100,000 shares that have been distributed, these are distributed from the company to the owners. The company then got money, capital, for this distribution. That is similar then to, and then times 2, the par value gives us this 200,000, which would be the amount, the dollar amount plus the additional paid in capital. But in essence, the common stock represents the issuance of stock from the company, and then the capital goes into the company. That's going to be similar if you look at a sole proprietorship or partnership to the owner investing money into the company as opposed to the company generating money through the operations. Similar thing here, except the owners are stockholders. And remember that the owners do not necessarily have to be the same people that actually issued or gave money to the company directly, because once the stocks are on the market, they can then be traded on the secondary market, of course. This would be representing the distribution from the company onto the market first. Then we have the par value at 2. The par value does not represent either the market value or what we sold them for. It's just an arbitrary number used to have a nice even relationship between the shares and basically the common stock total amount here, because the amount we sell them for will vary from time to time because we're going to sell them for the market price. So we don't have that nice even relationship. The par value will almost always be less than what we actually sell the shares for. And then the 100,000 in the capital in excess of par, additional paid in capital, you might hear it be called, that represents the money that we got over and above what we issued the stock for. So these two numbers here basically represent, the 300,000 represent owner's investment in the company. The earnings, retained earnings, represents earnings that have been generated from the operations of the company rolling through the income statement into the balance sheet. So it's operations over the life of the company that have not yet been distributed in the form of dividends. So that's the dividends then have to come out of the retained earnings. We can't typically dip into the capital account. That's one reason we have this different two categories within the equity section, because it helps us to break those two things out. So then, of course, the dividends would be coming out of the retained earnings here. And again, we're limited to the cap of the retained earnings. The other thing that's a little bit different from a corporation than is a partnership or sole proprietorship is that if you imagine a partnership, the owners can then take out the money possibly differently with a draw, which is similar to a dividend, money going out from the company to the owner, or a draw with a sole proprietorship. With a corporation, an individual owner, one shareholder in other words, cannot just take money out as the dividend, of course, because by virtue of them all being the same in units of stock, the dividends all have to go out kind of evenly. That's one of the downfalls or one of the costs of having this nice even spreading of shares that you can distribute out. So that means that they have to agree on, management has to agree on the dividend policy, and no single shareholder can basically, take money out without the agreement on the dividend policy, and they got to give the dividends evenly to all the owners and all the shareholders that have like amounts of shares. Now, the owners can pressure the dividend policy by basically pressuring who they're going to elect for the board of directors with their voting, and then pressure them to hire or fire management if they don't like what management's dividend policy is, which could very well happen, which means that management is often pressured to have some kind of dividend policy, possibly, if that's what the shareholders want, right? So we have the marginal principle of retained earnings. So the basic idea then, well, how much dividends should they be paying out? The one basic idea would be, well, if they used to determine how shareholders should best benefit from the dividend policy. In other words, we should think of this from the standpoint of the owners is one way that you would think about this, because we're acting as agents of the owner for management of the company. What would be best for the owners? Well, it could compare the rate of return on the earnings that we could get from holding on to the earnings to the rate of return that we think the shareholders could get elsewhere if we were to distribute the earnings. So in practical sense, we'll generally say, well, the company's probably going to have like a required rate of return, and they're going to sense that if they have the earnings and they have the cash and they can keep it into the company and obtain the required rate of return, which we assume is greater than what an individual investor could get if they were to get the dividend and then go ahead and invest it, then it would be beneficial to the owners for us to put it back into the company. Now, shareholders might not always agree with that because they might like the money because it's more concrete to get the money rather than putting it back into the company. But if the company can get a better return and you have owners that agree with that policy, the shareholders that agree with that, then of course the return is going to increase the value of the company because you're going to generate more revenue. The value of the company will go up, and that will increase the value of the shares to the owners. That's what should happen. So that would be a valid kind of way to go. If they could not then get a return sufficient that would be greater than what the owners could get themselves, the owners would benefit by giving them the dividend so that they can take that money and go invest it somewhere else. Note what is not the case here. The corporation, again, is not there. Some people kind of imagine a corporation that's there just piles up assets and just holds on to them like Uncle Scrooge. They're just piling money up just to see how big the pile can get. That's if the money is not doing anything, then you don't really want it in the company. If the money is not doing anything, if you're looking at the company, they got this huge amount of cash, they have no plans as to what to do with the cash, then it would benefit the stockholders to generally give it back to the stockholders so they can invest it somewhere else where they're getting a return on it. So the investment of the company need to have a higher return than the return stockholders could get in other investments. That's the general idea. Now, when you look at a company, one of the things that's going to greatly influence the amount of dividends that are going to be going out is kind of what stage of development you're in within the company's cycle. If you're talking about a company that's just starting and they're in the dollar stage, then they may not have any dividends because what they're trying to do is raise capital at that point in time. They don't have any excess money. Every dollar that they get, they're going to put back into the company because they're in the growth state of the company and they're probably trying to generate capital. And people that are investing in the company know that what they're looking for is growth. They're not looking for dividends, those types of investors. And then you might have the growth stage where you have stock dividends, low cash dividends possibly. So they might be giving benefit back in the form of possibly stock dividends as opposed to cash dividends, and the cash dividends might be fairly low. We're talking about this stage here, which again, you're looking at pretty steep growth. So that means that they're going to need to retain a lot of the money generally to reinvest it if they still have that growth potential. And then we have the expansion, stock dividends low to moderate cash dividends and stock splits. So you could have the stock splits and stock dividends here. This might be a situation where the price of the stock is getting high and maybe they want to do a stock split or something like that to actually lower the price on the market to something that would be more marketable to the average person during this stage, and that might be make it easier to generate money. And then you have the maturity, which is a moderate to high cash dividends. So at this point, you might see some decline over here, or you might just have maturity going on forever. If you have a nice stable company that's getting returns that are going to be a stable return over time, but they don't really need to reinvest it because they're already at the peak at that point in time. They've already built all the infrastructure. They do what they do, like they're the phone company or something like that, and the phone lines are already up. They're not looking to build any new phone lines or anything like that, and they're generating a good profit from it. Stable business. A lot of the big companies that you think of that are like, big staple kind of things are things that you would expect a moderate or a consistent growth or consistency, and therefore they're in a good position to give out dividends, and people that invest in them would probably be expecting dividends and very stable dividends for them. Why dividends are important. Dividends can reduce uncertainty to investors. So if you are an investor, then of course you probably like having the cash. Cash is nice that you're getting a return. People that are investing, depending on where they are in their investment cycle, are going to want dividends or not want dividends, and they're going to be picking stocks based on whether they want the dividends or not. But obviously dividends are more concrete than reinvesting the earnings. You get to see the dividends, right? If the company's saying, hey, we're just going to hold on to it and we're going to grow, and that's going to grow the value of equity. Well, that might be the case, but it's not as it's not as concrete as having the cash, which basically proves what you're saying if you're getting actually money for the most part, right? So dividends may be favored compared to retained earnings because of the added certainty. So remember, it doesn't mean retaining both of them should be good for the corporation. If the company is growing and if the company can get a larger return than the owner could, then by them reinvesting it, the value of the company, of the shareholder stock, should go up. And as long as they don't need the money, if they're getting a return on it that's better than they could get elsewhere, you would think it would be a good thing for the company to put it back in. But by giving the dividend, then of course they have the money. If they're short on the cash flow, that would be good. And it's more concrete because you're actually, you're kind of realizing the money. Taxes could come into play here as well. So stability of dividend policy. So stability is often a large concern to stockholders. So stockholders, it depends how sophisticated the stockholder is, but for large companies, then people usually like to see nice even growth rates, on their income levels, and nice even dividend policy. So if the dividend policy is jumping back and forth, especially if it's going down, that seem unusual, or that might be seen as negative to the shareholders. So shareholders typically like some consistency there. The dollar amount of cash dividends often is more stable, and the increase may take place when new permanent income levels are obtained. So generally a large company will start to generate new income levels, and then once they've had established that those new growth levels are not just a one-time thing, but something that they are going to maintain, then they may increase the dividend policy to match that. Note that if it's a short-term thing and they think it's going to go back down, then they may not increase the dividend policy because they don't want to basically lower the dividends. Lowering the dividends could be seen as a bad thing on the market. It could have a negative impact on the stock. And so therefore, they're usually going to wait. You would think, generally you would think you were going to wait till they think the increase in income is established and then adjust the policy of dividends for that. The market then predicting this behavior will then possibly see an increase in the dividends as a good indication, a good sign that we're talking about a healthy company that is growing.